Hello, everybody, and welcome to a special YouTube live broadcast. My name is George Papazov. I'm the owner and founder of Trade Pro Academy, one of the head traders here. I want to spend some time discussing about gold. It's October 5th. The question is, of 2016, the question is it time to start buying gold? And a quote comes to mind from a movie that Austin Powers is the name when he says, "I love gold." And it seems if you agree with that statement, there's a lot of opportunity for you coming up to get a chance to pick up some of the metal or the futures position at a discounted price. I think we're coming into one of the greatest opportunities here. I don't think the time is quite yet, but I'm going to back it up with a little bit of research, some technical analysis for you, some seasonality patterns, and a bunch of more things. So hang tight, and I'll walk you through it. At any point in this presentation, if you have any questions, I've opened the question box. Please pop it in there, and I'll stop to answer them at intervals throughout the presentation. I want to remind you that the information contained in this presentation is for educational purposes. It's not to be taken as investment advice or individual solicitations or recommendation. The risk of trading in securities markets can be substantial. You should carefully consider if engaging in such activity is suitable to your own financial situation. Trade Pro Academy is not responsible for any liabilities arising as a result of your market involvement or individual trade activities. The lawyers are happy. We're happy. Let's get started. First and foremost, I want to talk to you about seasonality. There are seasonal patterns, and this is pulled from seasonalcharts.com. It's from 2012. That's the last snapshot, but it's aggregate data of the last 30 years. So this is 30 years combined of data, and these months are overlaid to show you how gold prices move. What do you need to know? Well, from about January, gold tends to rally up into the end of February, at which point March gets softer. Through the summer months, April, May, June, July, we get some sideways patterns on seasonality on both equities and gold. But then look, July, August, September, when we really get into the summer months, it starts to pick up. The price goes up and away. And what ends up happening here towards the end of September, we start to get a little bit of a pullback, all right? And we rally to a new high to begin October. But almost always in the last 30 years, and there's a strong seasonality pattern here, is the last little bit of October tends to be a down period. So there's a lot of selling to end October, but something interesting happens towards the end of October. We reach a bottom and start to find some upside momentum. So the seasonality patterns in the current month that we're in of the year have always been weak in October, and then we rally at the end of October into the end of November and early December. So this is the opportunity we're trying to spot. From a seasonality perspective, it's currently October 5th, and I think we got some upside, but first, I think there might be a little bit more downside. So let's discuss that a little bit further. One thing you need to know is in the event of an interest rate hike, that will actually put some downside pressure on gold. And at the moment, I pulled the Fed futures. We are currently pricing in about a 59.8% chance that in December's meeting, the FOMC, the Federal Open Market Committee, will jointly agree to raise rates. They promised us 4 raises this year in 2016. We've only got 0. We got no rate hikes. So if we get it in December, this upwards rate hike might actually put some downside pressure. But what do we care? Up until then, we're going to have the seasonality of the week October to the end of November. We're looking to trade seasonality. We're not looking to fall in love with gold. We're looking to take advantage of its price movement to capitalize on it. So that still gives us a seasonal opportunity to pick up the weak October month and October weakness and ride it through November and get out before a rate hike, because a rate increase by the Federal Reserve and Janet Yellen will actually lead to lower gold prices. You need to know that, all right? That's a correlation that you need to respect. Now that we've looked at seasonality, let's jump into the exciting stuff and look at some charts that I want to share with you guys, all right? So let me just open up the charts for you here. Here's the price of gold. What you're looking at is a weekly chart. All right, where are we in relation to the massive trend? Well, since 2009, since the economic collapse and the financial bubble that burst, the housing bubble, 08, 09, gold has skyrocketed from a low of 700 to about 1900. So that was the great run. A lot of traders remember this, and they've clutched onto gold because gold is a safe haven asset. If you are bearish on equity, you are by default long on safe haven assets and stores of value. Gold meets that perfectly. So you should know if equity markets start to drop, gold will continue to rally. All right. Traditionally, not always. And I'll show you that correlation shortly. Where are we from there? Well, a lot of folks thought gold was going to end up going to $3,000+ an ounce, and it might, but just not yet. It had a correction wave down and another one, so we did a retracement. We grounded our way lower to about 1,100, and from there we popped to 1,400. Now everyone started to get excited. When everyone gets excited about gold or any asset class, I start to get nervous and cautious. So this extension from 1044 in late 2015, early 2016, that led us to 1380 in July of this year. First of all, this downside correction wave coincides with 1250 at the 38.2 Fibonacci level. If you're not familiar with Fibonacci sequences, I encourage you to check out our website, TradeProAcademy.com. We have a lot of free education on a 14-day trial. You'll find that stuff fascinating, how accurately and precisely it dictates and catches momentum flow and gives you buying and selling opportunity in your trade analysis and in your strategy. All right, 38.2%, that's the retracement. That kicks in around $12.50 per ounce. Where are we right now? $12.68. All right, so we got another $18 of downside to see if we could touch this 38.2% retracement on the price of gold. The other reason I like this level is there's a lot of chop. Every time you see a consolidation range, the middle of the chop represents the 50-yard line in football. Anything above, you make advancement. Anything behind, well, you're in your own end. So why do I say that? Because here, these are buyers that got long. These are sellers that got trapped whose stop losses got wiped out. That's just regular order flow and price action trading. So the middle of this range is where there's a lot of folks who are emotionally invested in gold. Okay, so when you get an emotionally invested level along with a technical level, these things start to make sense and it doesn't get as arbitrary. This week we had a huge sell-off in gold, massive drop. I'm going to measure it for you as of the end of today. So if you grab the high here, drop it to the where we currently are, not the low, but a 4% drop in 5 days. All right, so big drop this week in gold. We had to break out of this triangular action that we were seeing to shake out some people that bought it late. So now that we've kind of hashed out this level, 1250 to 1260, we got a buying zone. I call it a buying neighborhood. Now we need to get a little bit more granular and identify that level more precisely. So let's switch to a day chart on gold here and start to make some observations. First of all, today was the worst of all days, or yesterday was the worst of all days on the sell-off. Today we're getting some stabilizing here in the form of a doji. Don't be fooled. This doji could give way to some more weakness. There's some people who are buying into this now, absorbing some of the sell pressure. But usually when you see a big day like this, there's more to come. There's a story out there. When you see one cockroach, there's usually more. So careful, because this could be some precursor to weakness down to the 1250 to 1260 level we talked about. Ultimately, maybe even 1240. So we got to paint the green box, call that level 1240 and 1260. And we're going to try to find a level to buy in there when we get the right conditions. Well, what are the right conditions? Let's flip to a 4-hour chart. The right conditions would be as volume is dropping, or sorry, as prices are dropping, volume starts to decrease, not increase. Here on this sell-off, prices are going down, volume's going up on the 4-hour chart. That's not good. That means there's people leaning into that trend. On this downside, however, volume increased. So we had two massive sell waves of volume here, but prices couldn't crack this low. For the most part, it was absorbed below 1268 or so. All right, you're starting to see a bit of a floor build out. Now, if this volume starts to wash out and decrease as we hold this low, there's a good chance this guy pops back up to 1288. All right, so you got to notice something right now. If you're going to trade this thing, at the moment, you're not trading it, you're fading it. You're fading the down move. If you're going for a real tight risk trade, if you're going to say, I'm going to risk 1262, grab it long at 69 and go for 88s, that's a good fade trade. I can't fault you there. You're buying it here, hoping to make it back up to 1352. You're a little early. All right. If you're going to trade the trend, the timing is not right now. If you're going to fade this oversold, potentially oversold move, then great. That's a good idea. I'm with you. Now look at it on the 15-minute chart. Okay, on the 15-minute chart, it's starting to show some signs of selling absorption. Why? We get a massive sell-off, huge volume gets let off, another wave of volume, a bottom's formed, and we hold this sideways. On these rallies, however, overnight in the session, there was no volume. All right, that's because, first of all, we're an overnight session. Second of all, I don't know if interest was that appetite to get long gold here was that great considering this wave in their face. So what ends up happening today? Well, look at this. Around 1 o'clock, 12:45 to 1 o'clock, this sell-off changed. Something was different in the sell-off. What was different? The difference is volume's weak. Volume staying weak as prices are coming down. That's the difference. That's a huge difference because now sellers are no longer in control. You're not seeing this with volume getting cracked and coming up and coming up. Sellers are high-fiving each other and they're getting rid of gold and shorting it en masse, right? That's not what's happening. What's happening is prices going down, but not a lot of people are selling it, which means what's going to happen? Selling is going to eventually subdue for at least a temporary amount of time. Sure enough, what happens? 1264, there's a bit of a selling capitulation. And on this rally, it started to get exciting because volume came back. After a big sell-off, when prices go up and volume tries to return, that's your first sign that we might rest at this level as support. All right, that's your first sign. Now, if we see a selling wave overnight with volume starting to increase again, guess what? Go back to the 1 hour. That's not the location you're looking for it long. Go back to the 4 hour and then ultimately go back to the 1 day and pick a location. The way you trade any asset class is to find a location. All right. I use my analogy, find a neighborhood and then look for a house that you want to buy. So the neighborhood is right here, 1240 to 1260, tons of support. We're not just going to come through and crack that easily. We're going to bounce, and that will give you the best opportunity to catch a position with the lowest risk. As a trader, you're not looking to make the most amount of money. You're looking to manage risk. Traders who manage risk most effectively are the ones that make the most amount of money. Go figure. All right, your job is number one, manage risk. And if you're a good risk manager, number two, make money. So many people get it wrong and chase returns, taking huge risks to try to generate those returns. In the long run, account equity that looks like this will end up like this. What you're looking for is consistency, upward, nice sloping trend in your account balance. And you're going to get that with proper risk management. So how am I going to manage my risk? I'm looking for 1240 to 1260 on the daily. On the way down, I'm looking for 4 hour, 1 hour chart, and I'm cycling into 15 minutes to identify points where selling gets exhausted and buying starts to show some volume for a nice low risk entry to try to fade this. All right. That's what I'm looking at. Let's compare gold to the S&P 500 index. Let's have a look at it here. Well, what are we seeing? Typically, these are inversely correlated because when market goes down, like I mentioned a few minutes ago, gold prices go up. Well, isn't it funny that the S&P 500 right now is in a triangle in a holding pattern and gold just absolutely cratered and fell through? All right. I think what had to happen in gold, this sell-off had to happen because we had what? 1, 2, 3, 4, 5, 6, 7, 8 different touches at this level. Let me just get rid of the SPY for you. 8 touches at 1310. How long was it going to hold? Too many people bought and got long on these dips. That's why this had to happen. When too many people get long, the boat tips. It's like a boat that's floating in the water. All right, here's water. Here's the hull of the boat. Here it is up top. This boat sells tickets really expensive at first to get a few people on board. Towards the end, it sells those tickets real cheap because they need more participants. And when the boat tips, they all fall off. All right, tickets were cheap. It was really easy to get in and start getting long in gold here. And tickets were so cheap that at some point, boom, the ship tipped. Think about it. If it starts to look way too easy as a trade, it's definitely not worth putting money behind it. Like here, great, good long there. Here, phenomenal long. In fact, that was long for gold here. Here, another shot, but it started to get a little more risky. And each high was lower and lower. All right, down here, I know a lot of retail traders that got long gold. And I screamed it from the rooftops. Don't get long gold. It's different this time around. Sure enough, it breaks below it. All right. It was way too easy. When it does about 7 touches of support, even the everyday guy that knows support will say, hey, well, look, this is support. I'm going to buy it. And that's when it blows right through. So careful on gold. Back to the correlation I wanted to show you here. If you compare it with the S&P 500, all right, what are we seeing? Let me just zoom out a little bit. We're seeing the S&P 500 coiling for a potential pop. All right, I see some higher equity prices on the S&P 500. I know that there's a lot of tensions globally from an economic sense, and I know the economy is not doing spectacular. Most middle-income contributors to the economy are making less money. Their wages have stagnated. A lot of Full-time workers are doing 2 part-time jobs. That's not 200% job growth. That's one discouraged worker. It's one really upset worker that has to work 2 part-times to make ends meet. I know the economy is not doing well, but the equity markets are screaming higher on free money, low interest rates, insane valuations in the market, stock buybacks, which are now starting to slow down. So I see a little bit more upside taking us into December. I know October statistically is a really bad month for equities. If we could make it through that slump of October, I see some upside in preparation for this interest rate hike. We hit 2,200 and then we drop in equities. I think on the S&P 500, we've come so close to 2,200 to not touch it. If we get up there, we give it a slight kiss on the cheek, and that's the kiss of death before the stocks absolutely crater, start to leak lower. And that could be the catalyst on the interest rate hike in December. We've also got an election to get through. All right, there's a lot of uncertainty coming in the markets. Traditionally, in the face of uncertainty, gold's a good asset to own. All right, so there's my equity outlook. I'm not saying get long or short yet. In fact, do your own research. But from a gold standpoint, I really see us tapping 1250, giving it a little nudge, wiggling this 1250 level, 38.2 retracement before we even remotely start looking for a longer term opportunity. If you want to get a fade, I'll tell you what, this looks like a good fade zone right now. Just go on the 15-minute chart, grab a fade from here. Okay, there's a few ways to trade this, and I'll show you my option strategy. Way number one is to get long GLD. All right, here's the ETF. Let's go on a daily chart. All right, one way to get long gold if you think you're going to get long. And look, I marked 119.83. This is my personal chart. I'm trying to buy it there. I'm waiting for that price action. Okay, I took a fade position small today at this bottom. And if it doesn't carry through overnight, then I'm going to get out of it. But one way to trade is GLD. This is an ETF. It trades on the market. And you could purchase this at 120 a share. Another way is to do options. All right, trading options. I'm not going to go into too much depth. I have an entire options course that we put together at TradeProAcademy.com. It's phenomenal, 10 lessons, everything you need to know about options and how to trade them like the professionals. All right, so, and it comes with a free 14-day trial. So, what I wanted to tell you about this is GLD, my entry point's 119.83. That's kind of what I'm waiting for it to tap. Look, it's down at the 200-day moving average. It should find some temporary support. All right, Bollinger Bands are starting to open up, volume's coming in, and momentum's starting to hit oversold levels. Careful on momentum, though. Many traders say, well, momentum's oversold, it's time to buy. No, it's not. It's an indicator. When you're driving your car and you see the gas light come on, you slam on your brakes on the highway and say, oh my gosh, I need gas. No, you got 50 kilometers or so. Some cars even have up to 100 kilometers to coast and find a gas station, right? Same deal on the market. I know that we're oversold. I know that the gas is kind of running on empty, the tank light flash, but you still got some kilometers, enough to take you out of a long. So don't, just because it's oversold doesn't mean you got to start buying. Have patience. Look for some more definition on a price candle chart. Look for some more volume confirmations that the selling is done. I don't think it's done yet. I think we might pop, and then at 122, bring it right back down to my target of 119.83. All right, that's what I'm looking at for GLD. The option strategy I'm going to be doing is purchasing probably the 119 calls. All right, I'm going to buy 119 calls and try to sell these 123 calls. Okay, so if I sell a 123 call and buy a 119, this creates what's known as a debit spread. No professional options trader that I've known or do know, and I know a ton, no professional options trader is buying a straight call option. I know that the majority investing crowd sees this at 120 and says, I'm going to buy a 128 call option because it costs 10 cents. And if it gets up there, I'll make thousands of dollars. The odds are so low. That's why it's a cheap ticket. All right. These are gambling odds. These are not, it's basically gambling at this point. This is a moonshot trade. That's what we call it. I'd sell you that call option. If you're going to do that, if you want to buy 129 call for end of November, give me a call. I'll sell it to you privately. All right. Don't do that. What you want to do is buy an in the money call option and sell an out of the money call option. This creates what's known as a debit spread. There's a lot of characteristics to help you manage risk. What I say earlier in the webinar. What I say, good traders manage risk first, make money second. All right, so it helps you manage risk. In the long haul, You're trying to not lose and cut your losses. Making money will come. It's a function of not losing and cutting losses. All right, so I'm going to be buying 118 to 119 calls, whichever one has about a 65 to 70 delta at the time that I want to get long, and selling approximately 123s. As it starts to move up, I'll do another spread. Price is up here. I'll buy a 122, sell 127, and I'll ride it up in increments. A cash out. I'm looking for November to December expiries. All right. Remember, this is not a recommendation or trade solicitation. Do you guys have any questions? See if you viewers joining in. If you want to, you could. I have the comment box opened up. All right. That's what I'm looking at for gold. If you want to look at it from a volume profile standpoint, I wanted to show you this. This is really neat. Let me zoom in here. This is 15-minute GLD chart. Look how much volume got let off today. Huge amounts on the ETF at this price point right here. And this price point is 120.83. Massive volume. A lot of people tried to sell this thing into the close. Huge volume pop. All right. The last volume increase was on the rally. The volume increase below that was on the open. Massive volume got traded on the open. But this volume is holding as support. All right. Previous or current high volume nodes end up acting like support and or resistance. So if you get a break out of this 121 on a shorter time frame, this is 15 minutes, where are you going to target? I'm targeting 122.62. Nothing crazy here. I'm just looking for a little bit of upside. Above that, we have a huge gap as resistance, and I don't think we get up to these 125s until we head lower. So once again, if you're looking for a long here, understand it's not a trade. Don't call it a trade. Don't fool yourself. It's a fade. There's a Mack truck coming, and you're standing in front of the way, and you're betting that you could pick a penny off the ground before this Mack truck comes and hits you. Sorry, I'm not really good at drawing. But that's what you're doing. You're saying, let me grab this penny. All right, woo. The Mack truck passes in and out. That's a fade. A trade means let the Mack truck pass and jump on board. All right, you got to always know, are you trading or fading? That's GLD. That's what I look at. I've given you guys my levels. Let me just review them very quickly. I've given you my reasoning and rationale behind why I want to get long gold. On October 30th this year is the beginning of the Indian holiday Diwali. And this celebration usually ushers in a lot of physical demand because they end up buying gold. Let me spell physical properly. A demand for the physical gold commodity, and that tends to give it a little bit of a boost towards the end of October. All right, so here's my reasons for wanting to get long gold, but not yet. Number one, all right, we're looking at some retracements that are coming in that could support us. Number two, I see some potential weakness in overall equities. I'm seeing weakness. I'm seeing the ice crack. It can still go up, yes, but I'm seeing a lot of downside pressure. All right. Number three, seasonality. Seasonality is a trend that's in our favor. Okay. September is usually a rally. October is a sell-off, but end of October and November, it starts to rally upwards. So I'm seeing a lot of reasons to be long gold. Number four, I think at some point it's going to be oversold. I think when you start hearing in your commutes to work people mentioning, "Oh, did you hear about gold prices so low? Wow, it must suck to be owning gold. How terrible is that?" That's when you start buying it. When you hear the everyday person talk about things that are happening today, start buying the thing. Okay, so I have reasons to get long. What you need to pick is a neighborhood. Okay, and I'm going to leave off the webinar here if you guys don't have any questions, but you need to pick a neighborhood. Where do you want to get long? Pick a zone and identify, is this a trade for a longer term opportunity or is this a fade? Am I just trying to catch an oversold move and pop it back a couple points? Okay, if it's a fade, then have really tight risk. If it's a trade, it's not time to trade long yet. The downtrend is still intact. All right, my zone. Here's my zone. I told you why I want to get it. I've shown you correlation studies, seasonality. I've shown you what the Fed could do in equity pressures. 1240 to 1250 to 1260 is kind of, I know it's a wide zone, but I'm looking for it here. For what reason? Fibonacci, mid-range of a battle. And I'm going to wait for it to get down there. If it just jumps up and goes against me, great. How much money did I lose? I'm not in the trade, zero. I've never lost money on a trade I haven't taken. Okay, never lost money on a trade I haven't taken. I could sit on the sideline and watch it without me and still be happy. All right. but I need to try to catch it in this middle consolidation off of support from Fibonacci, price action, and then I'll be flipping to 4 hour, 1 hour, and eventually 15-minute and looking to snipe a nice entry in there. Any questions, guys? So to answer the question, gold, am I buying? Not yet. Is it time to start buying? No, the timing is not right, but it's coming. It's coming really soon. Pick a location, have a plan. When you get all the things on your trading plan checked off, take a shot. If it's worth the risk, it's worth the risk. Traders all too often look for certainty. They say, wow, this trade, tell me a trade that's certain. Or I love when people say, tell me a trade where I can make a lot of money. How much do you want to risk? Nothing, 0%. All right, why don't you put it in your bank account? Or, by the way, if they cut interest rates, eventually it's going to be negative interest rates. If you're Germany, if you're out in Europe, there's negative interest rates. They're charging you money to hold it in your bank. So there's a negative return. So it's risky to hold money in your bank nowadays. Okay, so how much do you want to risk? 0%. Well, then, good luck to you on that. When you find a 0% entry on a chart, when you find the least amount of risk to get long with the most amount of certainty, I'll take the opposite trade that you do because everyone's seeing it. Everyone's getting greedy and getting long. And this is what I could tell you is what caused the snap of this support, 1310. It says, wow, look, it's bounced here before. It's done it again. It's done it a third, fourth time. Obviously, the fifth time's a no-brainer, zero risk. You just put my stop here, right? And guess who else put their stop down there? Everybody else. Guess why the price went down so fast? All these guys that had stops that trailed it higher, all these guys that started getting long too late, the guys that bought the dip, they're all getting stopped out at the same time right now. We're on the sidelines waiting for the price to come to us. Wait for it to come to your neighborhood of 1240 to 1260-ish. You'll know when the time's right. Trust me. Don't jump the gun. Don't look for too much certainty. You're going to have to take a little bit of risk to make money in a trade. But as long as you know that risk, as long as you control it, and as long as you know when you're going to get out, when will you close that risk? That's the most important. If you know those three things, go for a trade. All right, guys. Any questions or comments? Did you guys enjoy the webinar? It's kind of like a special report more so than a webinar. But there you have it. Have yourselves a phenomenal afternoon, evening, morning, wherever you might be. Enjoy the rest of the day. If you have any questions or comments, pop them in the comment section in YouTube below. We'll monitor them and get back to you. And I also encourage you to have a look at tradeproacademy.com. It's our training and development course. We have literally tons of lessons, over 60 hours of education. We have a support resource for you. We've put together all the resources to give you your best shot of being successful and profitable. So at the end of the day, you can use all the free resources on our internet. All you're going to get is confusion. All you're going to see is a pile of stuff, and you're not going to know how to use it. And trading is not about knowing where price is going. It's about executing. I can't tell you how many times people say, George, where's gold going to go? If I told you where it's going to go, would you make money? Probably not. It's all about execution. Forget about trying to have a genie and a little lamp to rub to tell you where price is going to be. Start picking locations, start picking entries, start executing properly, and you could do that with a group of professional traders at Trade Pro Academy. All right, join us, 14-day free trial for free education. If you want to sign up, we also have regular market commentary, daily updates of trade ideas, and we take all these live on our account. I show you my personal account that I use, show you the profit and losses. It's full and transparent. It's not a trade signal service. If you're looking for somebody to tell you what to buy, go out there and buy a TV and watch it because I can't help you there. But if you're looking to learn with somebody, this is the resource for you. Do you guys have any questions or comments before we call it a night? I hope to see you join Trade Pro Academy. We got a ton of resources, and all too often people tend to think this isn't for me. I can't do it. I don't know math. We can help you through that. You don't need to know math. If you can add and subtract, you know enough math to trade.